The S&P rebounded today as AMD reported better than expected earnings in its latest quarterly results. Other companies in the AI sector also boosted the markets after valuation concerns just yesterday. Let's go to Darius Dale. He's co-founder, and CEO of 42 Macro. Thanks for joining us today.
Hey, Merella, thanks for having me. I appreciate you.
What factors do you consider when looking at economic growth in the U.S.? Because I know that's one of the things you're taking a look at.
Yeah, that's a great question. So obviously we remain in this government shutdown here. So we have to rely a lot more on leading survey data and data from alternative sources. And by and large, they're confirming the resiliency of the economy, which is a theme we've maintained for over 3 years now. We got the ISM services report this morning, and it was very much in support of an economy that is poised to rebound, particularly when you look at the spread between the backlog and new orders. And so it's our view that we remain on this sort of train track towards a much more expansionary economic environment over the next couple of years.
You mentioned that you're looking at other sources of information with the government shutdown. Is the government shutdown a drag on the economy?
Oh yeah, of course, of course, it's a drag. I mean, but how big of a drag is it going to cause a recession? And the answer is small and no. And so in that context, I think we need to move on as investors and focus our attention, our focus budget, if you will, on things that are more impactful for asset markets.
Okay.
In our opinion, we think that. Oh, go ahead.
No, I'm just wondering. You've got a massive government. You've got a massive population. How could a government shutdown that goes so long not really have a massive effect on the way things are run in the country?
Well, if you just think about the categories of spending that are actually impacted by the government shutdown, it's actually not a tremendously large amount. Obviously, if people stop showing up for work at the airports and whatnot, that's where the real shutdown impact is likely to that's where we're likely to see in the economy. But I would turn our attention away from the shutdown because I think it's an overcovered news story to an undercovered news story, which in our view we continue to anticipate. At least our models continue to anticipate structural regime change at the Fed. We think that's the number one story that folks are not paying attention to right now, that markets will be paying attention to in the next 3 to 6 months.
Okay, can you explain a little bit more what you're seeing?
Yeah, so our research continues to indicate a Federal Reserve that is K-shaped monetary policy. It's creating all sorts of adverse distributional outcomes, negative outcomes for the consumers and the households on the bottom of the K. And as a function of that, we're seeing an increased amount of pressure from thoughtful investors and economists and obviously the administration circling the institution, and they'll eventually sort of land their punch in terms of trying to get this institution to realize the negative impact that it's having in terms of perpetuating the K-shaped economy. And so ultimately, we're going to see, in our view, until we get something that pushes us off this theme, we think we're going to see a much lower term structure of interest rates next year. And we may even see some creative balance sheet policies to address these K-shaped outcomes that we continue to see in American society.
Has there been any indication of a stimulative effect from the cuts so far?
Not really, but again, monetary policy works with a long lag. When you look at our business cycle model, it's about 18 months where you really see the full impact of monetary policy changes, both up and down in terms of policy rates. But that doesn't mean that markets can't price in what is likely to be a more dovish Fed, a Fed that is more supportive for economic growth, particularly growth for the households and consumers and businesses that have been left behind in this economic expansion, this K-shaped economic expansion.
We talk a lot about valuations and where they sit, especially with the tech stocks. And we saw a big pullback yesterday for the TSX. It was close to 500 points. We've seen the markets come back a little bit back on today. But are you concerned at all about a correction?
Yes, yes, I'm concerned about a correction. No, I'm not concerned about a bubble. So let me take the first part of the question and answer the second part of the question. On the first part of the question, very much concerned about a correction. If you look at our position model is now signaling high risk of a crash in risk assets over a medium to long-term time horizon. That's just a function of the amount of indicators in that model that are breaching their bull market peak thresholds. And so that tells you that the positioning cycle is very full, and in fact, it's lopsidedly bullish. And so pretty much anything could cause a correction here. A squirrel could get hit by a bus and the market could correct from this starting point. And so, yes, we have to be very much on guard for a continuation of the correction. In our opinion, the number one catalyst for that is this pushback against market pricing for a December rate cut and the Fed's ultimately tardy response to some of the repo market developments that we've been highlighting. With regards to the bubble, in our opinion, the bubble is, to borrow a phrase from our friend Eddie Gabor over at Key Advisors, bubble is not a four-letter word to investors. It's the pop that's the four-letter word. And so in our view, we think we are a long way away from the bubble popping. We could be wrong on that, but our risk management signals Our institutional grade risk management signals have not signaled that outcome yet.
Okay, so given where we are right now for you, what sectors do you like? Where would you put money in?
Yeah, I think it's going to be a lot more of what's been working. You're going to so it's technology, consumer staples, or sorry, not technology, consumer technology and communication services in terms of the digital economy growth. We think investors are going to start to broaden out as they get more confirmation over the coming months that the economy is on sounder footing and heading for an acceleration in growth that we believe is likely to surprise consensus estimates to the upside by a material degree over the next couple of years. And so that means you need to attack some of the real economy growth sectors in particular. So that's financials and the home builders as well. And then in terms of where you don't want to be, you don't want to be anything that's slow growth right now, particularly anything that's going to have tariffs moving through its P&L. So consumer staples are obviously an issue there. Healthcare is another issue from our perspective. So
Okay, some of the healthcare we know in the U.S. has started to come back, but you're not positive on it.
no, I mean, again, when you're in a risk on market regime, you want to be taking risk. That's kind of the general takeaway. You want to be going further out on the risk spectrum. So high beta cyclicals from an equity factor and sector perspective. And so that obviously means you need to be underweight consumer staples, healthcare, these sort of more lagging, slower growth, lower beta type sectors and factors in order to outperform. They'll obviously go up if the market goes up, but the reality is, as an institutional investor, your job is to pick factors and outperform. And so that's what we do at a very high level for our clients here at 42 Macro.
Got it. Darius Dale, I'm going to leave it there. I'm out of time. Darius is founder and CEO of 42 Macro. Thanks for your time.